Markets down 10 to 12%. What should smart investors do? Is this an opportunity or a trap? The Nifty 50 has fallen down from the levels of 26,000 to 23,000 and hovering somewhere around 23,500. But something very interesting has happened to its valuations. When the Nifty 50 PE drops below 20, it creates a sweet spot and it generates a lot of good investing opportunities for creating long-term wealth. Hello friends, welcome back. I'm Dr. Atul Sawant, your doctor of finance. Whenever there is geopolitical tension in the world, the market reacts sharply. When there are wars, there are sanctions, economical uncertainty, crude prices going up and down, then entire world reacts very strongly, especially the financial markets. And the markets are nervous because of this US and Iran war. As a result of this war, the markets have corrected around 10 to 12%. And as usual, the investors are asking the same question. Should we buy more? Should we hold? Or should we sell our investments? Because nobody knows where is the bottom and how much down the market can go from here. Today I will discuss with you something very important. Not just how to invest in this market, but how some smart investors create a huge amount of wealth in this market. Today I will tell you what history tells us, why valuations matter, what are the pros and cons of investing in a falling market, and how to apply all the knowledge you learned today practically. Why market corrections create opportunities. See, whenever market falls down, there is fear. And because of this fear, investors start thinking that there is going to be an economic slowdown. The market will fall down even more from here. And what if the war prolongs? The news channels show that there is gloom and doom everywhere and the mood is generally very pessimistic. But history tells us something different. Whenever there is fear, there is also opportunity. And whenever there is fear, along with it, there is something called as valuation, which become very attractive. One of the most widely used indicators to understand the valuations of market is the PE ratio or price to earning ratio. It tells us whether the markets are cheap or expensive as compared to its earnings. To understand the example of PE ratio, I will show you a simple example. Suppose if you want to buy an iPhone which is costing 1.5 lakh rupees and now the same iPhone is at a discount and is priced at 1.2 lakhs only, 30,000 rupees discount, then what will you do? See, remember the iPhone is the same camera, same iPhone 17, same processor, same battery, everything same, but only the price has changed. Initially, it was priced at 1.5 lakhs, but now it's cheaper at 1.2 lakhs. What will a smart buyer do? He will definitely buy. But in the share market, when the same happens, when the same company with same valuations is available at a discounted price, people panic and they think of selling, forget about buying. So don't do this mistake. Just remember that if the market is at sale or the PE is low, it's at a discount, then you should definitely think of buying more rather than selling at a cheap price. Historically, the average PE of Nifty 50 has been around 23 to 24. And when it goes beyond 25 to 26, the markets become slightly expensive. But when the PE falls below 20, then the valuations become attractive. As of now, the Nifty 50 PE is around 20.2 to 20.4 and it is near the zone of attractiveness. Let's see what history tells us. The Nifty 50 PE has gone down below 20 for a very few number of times over the last 20 years. In the 2008 market crash, the Nifty PE fell down from 28 to 11 to 12 levels. Imagine the level of fear at that point of time. But do you know what were the returns after that 1 year? In 2009, the Nifty returns were 76% in just 1 year. And over the next 3 years, the CAGR returns were 15 to 18%, which was superb. See, the sharper the fall, the better the recovery. In February 2016, the Nifty PE went down to the levels of 18.6. But after that, there was a nice rally over the next 2 to 3 years. And Nifty reached the levels of 12,300 in 2020 and the average CAGR was 15%. And the next was our favorite, COVID crash, March 2020. The Nifty fell down from 12,300 and went to the levels of 8,000. And then the PE tanked down to 17.1. Next was in June 2022 when the PE fell down to the levels of 19. From that again there was a good recovery and over the next 2 years we got good returns of 26% CAGR. After 2024 the market has been dull. And actually the investors have been pretty disappointed. So what does history tell us? Whenever the markets became cheap, whenever the fear was high, whenever we felt that everything is going to go down, all the people who invested at this point of time got excellent returns. But does it mean that the markets will bottom down at a P of 20? No. In 2008, we saw that the markets went down from the levels of 28, the P of 28, to the P of 11. Imagine the fear and the panic that must have happened. Presently, the P is 20 and people are panicking. Imagine if the P of market goes down the way in 2008. I don't think so it will happen, but if in case it happens, imagine that the market will be 50% of the present valuations. I'm not trying to fear monger, but I'm just presenting a scenario. If that happens, people would be really scared. But that's the magic about investing, and that's the magic about stock market, that when you invest, when everyone is fearful, that is the time you will get the best returns. The history has showed us very clearly, the sharper the fall, the faster and the better the recovery. There will be a V-shaped recovery if the fall is very sharp. But if the fall is just very small, like as of now, the recovery also will be slow and not that great. Important truth, nobody can time the bottom of the market. Markets don't ring a bell when they bottom out. So the P, which is 20 right now, can even go down, say 18, 19, 17, 15. I don't know what levels, but it can go to any levels. All depends how you react when the market goes down. Do you have the courage? And most importantly, do you have the money to invest? History clearly shows us that when the markets go down, the risk to reward ratio improves and it becomes more and more in the favor of the investor. Always remember this. Pros and cons of investing in a falling market. See, let's discuss the pros first. Better valuations. As the markets fall, the valuations becomes cheaper and good companies are available at a reasonable or cheaper price. Higher future potential returns. Of course, when the market bounces back, the returns will be even better. Fear creates opportunity, and when the market keeps going down, the fear increases and the opportunity increases. Your risk to reward ratio keeps on improving with every % fall in the market. Always remember that. And in the long term, best investments are made during market downturns, not during the market peaks. But there are risks too while investing in a falling market. The markets can keep falling down further, and because of that, a 10 to 15 or a 20% fall can severely impact your portfolio. Emotional pressure. Seeing your portfolio go down negative day by day creates a lot of pressure, and holding yourself requires that you are emotionally and financially very strong. Global uncertainties can long a very long time, and it might not be a very quick recovery. So there can be a protracted period of time when the market moves sideways, downways, and you will be stuck there for a long period of time. Practical strategy for investors. So what should investors actually do? Number one, never ever stop your SIP when the market is falling down, and always continue them. Number two, assess your cash position. This is very critical. Understand what is your cash position, how much money you have every month to invest, and how is going to be your cash flow over the next 6 to 12 months. My simple fund is, with every 1% fall in the market, I will invest 5% of my capital. That's it. Very simple. So if market keeps falling, I will keep deploying my capital. But what if the market bounces back? I will still keep investing systematically. Always invest your capital in a staggered manner and not all together. If I have 100 rupees, then I will divide it into 20 small pieces of 5% or 10 small pieces of 10%. And then with every market correction, I will keep on investing those chunks. Next is asset allocation. Remember that you should always follow your asset allocation. Asset allocation means that if one asset goes down, then you will not remove money from this lowered asset. But if you have some money from some other asset, you will use that money and put it in this asset. In this way, you will always buy low and sell high. Remember that. So if I have some money in equity and some money in fixed deposits, when the markets go down, I will not put more money in fixed deposits. In fact, I will remove some money from my fixed deposits and put it into the equities to complete my asset allocation. I will always try to buy low, not high. So guys, what are you doing? What are your thoughts about this market correction? Do you think it will go down more? It will rise from here, or it will stay at these levels only? Are you panicking, or are you thinking that this is a golden opportunity and investing more? Do let me know in the comment sections. If you like the content, then do give me a thumbs up and subscribe to this channel. Your small subscription will not cost you anything, but will definitely help me grow, and it will give me an idea that the content which I'm making is good and the audience is liking it, and so I can make more of such content. Thank you very much. Signing off. Take care. See you soon. Bye bye.